right, everyone, so we're going to get this meeting underway. We are still missing Daniel, our geologist. He's on his way in, but we're just going to jump right into this quarterly capital budget meeting.
We're looking forward to discussing the La Pointe deposit and whether we can make it into an operating gold mine.
Hi everyone, sorry I'm late. The helicopter is late leaving the site.
Great to have you here, Daniel. We're looking forward to hearing your thoughts.
So before we go any further ahead, we are a large corporation. Most of us may not know each other at this table, so we'll just do a quick introduction. My name is Josiane Green, and I'm the CEO of Gold Digger. Let's go around the table and introduce ourselves.
Sure. I'm Cynthia Perrin, and I'm the CFO of Gold Diggers.
My name's Jimmy Gutman. I'm with the Gold Diggers environmental legal team.
Hi everyone, I'm Daniel Levin and I'm the Chief Geologist at the La Pointe mine site.
Hi, I'm Kenna Olson and I'm on Gold Diggers accounting team.
And I'm Julia Quigley. I'm also on Gold Diggers accounting team.
It's great to meet you all. I'm Arun and I'm an investment banker from CIBC. I look forward to learning about the mine.
Great. So as you can see in the agenda, we're going to begin our meeting with outlining the preliminary research that our teams at the mine sites have carried out. Our accounting team, Ken and Julia, are going to walk us through the cash flows. Then we're going to talk with Jimmy and discuss a bit of the risks associated with the project. And lastly, hopefully with all this information, we're just going to be able to make a decision. And let's have our rock star, Daniel, take it away.
Thank you, Josiane. I'm super excited to announce that we have a proven gold deposit of 2 million ounces at our La Pointe mine site. We've conducted numerous geophysical and geochemical analyses to arrive at our best estimate for the dimensions of the deposit. From a geological perspective, this site contains high-grade ore and is easily extractable. Up on this map, we can see our site in yellow and other similar operations nearby.
To add to that, British Columbia is a mining-friendly province, and we have carried out feasibility studies. Likewise, we've reached an agreement with First Nations in the surrounding areas, and we have a plan in place for employment opportunities. From a legal standpoint, our rights to the land are rock solid. In addition, fortunately, there are low political risks in Canada. We'd be operating in a stable, regulated tax regime, making our procedures for obtaining permits relatively easy.
Wow, so that sounds like we've got a lot of good news ahead.
And we're excited to announce our provincial and federal environmental assessments have been approved.
Great. That's great news, Daniel, and a significant milestone. When we're looking at a capital budgeting decision, we want to make sure we have all our alternatives discussed.
Right now, we have the option of either accepting and developing our La Pointe deposit into a mine or selling the deposit to a third party.
Or we can wait. Our La Pointe deposit is located in a mineral-rich area. We have copper, lead, and zinc nearby. As of now, gold is our most proven deposit, so we require more exploration for the other minerals.
We did look at the cash flow of the other commodities. Not only is the La Pointe deposit the most proven, but it also yields the greatest bottom line.
Okay, so we've decided that gold is our best option. How about we look through some of the numbers?
So we've estimated the initial capital cost required to begin the mining operations to be $900 million. This cost includes building the mine infrastructure, improving roads for better accessibility, and all mining equipment. This is based on historical data from similar mines in the BC region.
How long will the mine be in operation?
Based on the data provided by our geology team, we have estimated a 10-year mine life.
And after all of the mining operations have ceased, have you taken into account the environmental cleanup costs?
Yes, we have estimated the cleanup cost to be $40 million for the 3 years following the end of the mine life. In present value dollars, this amounts to $21.2 million. This also results in an accretion expense of $1.6 million per year in our operating costs, which Julia will now discuss.
So we've allocated our operating costs on a per unit basis, and we've estimated an average cost of about $600 per ounce of gold mined. And the $600 is broken up into various cost components. And the depreciation portion can be broken up into 4 expenses, which include the amortization to the rights of the land, the accretion expense that Kenna just talked about, the depreciation of all the mine assets, and the depletion of the reserve based on units mined. And we've used an average cost or price of about $1,500 per ounce to determine our per unit margin.
Where do all of our preliminary exploration costs fit in? At what point do we have to pay those back?
Actually, Daniel, that's a really good question. Given that these costs occurred in the past and are no longer recoverable, they will be a sunk cost and therefore would not bias or influence our decision.
And so these sunk costs, so all the exploration costs, have been capitalized to the LaPointe Reserve, and they'll be depreciated over the 10-year useful life of the mine.
By developing the gold deposit, would you forego the opportunity to develop the other commodities that you mentioned?
Unfortunately, yes. The mine equipment required for gold is highly specialized, and therefore we could consider the potential benefit from the other commodities as opportunity costs.
Okay, so now that we've had the chance to discuss a lot of the costs, let's go into something a bit more interesting and talk about the revenues.
There are a number of different capital budgeting techniques available, and every industry uses certain standards when evaluating their cash flows. The standard in the mining industry is to use a discounted cash flows analysis.
Thanks, Arun. So let's take a look at our projected cash flows. From this graph, we will see our initial capital cost of $900 million and the undiscounted cash inflows and outflows for the 10-year mine life. We will increase our production from 50,000 ounces of gold to 200 ounces of gold over the useful life.
The output changes as a result of improvements in extraction infrastructure over time. The total ounces of gold mined amounts to 1.5 million.
I thought you said there was 2 million ounces of gold.
There absolutely is. However, we've estimated 500,000 ounces of scrap material which have no extra processing costs. These 500,000 ounces are typically lower grade and will have no recoverable value.
So we have used net cash flows to calculate the net present value and our internal rate of return. We used a discount rate of 5%, which is our standard rate of return. The net present value showed a positive number of 87 million, and the IRR was determined to be 7%, which is in fact higher than our discount rate of 5%. These two methods show positive results.
We also use the payback period method to determine the feasibility of our project. And as we can see from the graph, our net cash flows would only recover the cost of the initial investment after around 7.5 years. So this method rejects our project, as here at Gold Diggers we require between 4.5 and 6 years to recover the cost of the initial investment.
Julia, however, the payback method is not a reliable technique in capital budget decision making, mainly because it doesn't take into account the time value of money.
I also have data from an independent third party who has appraised the value of the deposit. The calculated value of the deposit is estimated at $79 million.
Right, so since the NPV that our accounting team calculated exceeds that of the appraisal value, we are tempted to move forward to accepting this project and developing the deposit into a mine.
The mining industry commonly uses the accelerated capital cost allowance rate of 75%. Every year, your taxable income will be reduced as a result of the CCA tax shield. This is important when considering long-term investment projects.
Absolutely, Arun, and things are looking good so far. However, there are a number of risks associated when taking into account capital budgeting, especially in mining. As well, there are limitations to the PCF model.
We can start with the commodity price as a risk. The projections of future cash flows are based on an estimated price of $1,500. The estimate is based on trend analysis and political climate. We could expect significantly upside in safe haven commodities, such as gold, given the recent outcome of the election and the uncertainty that comes with it.
Exactly. The prices have fluctuated from around $600 to $1,900 over the past 10 years. We need to take into consideration the element of uncertainty when making our decision.
Exactly. If the price of gold drops below $700, we will have to reconsider mine operations. We may need to either halt operations or significantly reduce our production.
This could negatively affect your shareholders. We would need to restructure your debt in order to maintain your reputation.
This could also negatively impact the First Nations relations and the benefit agreements we have in place. This is all to say that the price volatility affects many factors beyond just the numbers.
However, due to the uncertainty related to the price of the commodity, many mining companies will enter into hedging agreements to minimize their risk of exposure. Hedging helps reduce the risk of revenue losses should the price of gold decline.
Exactly, Julia. However, the drawback of hedge accounting is that there is a possibility that we will not realize all of our potential benefits. This would occur if the price of gold were to exceed that has been established in the contract agreement. We also note that the discounted cash flow method does not take into consideration hedge accounting.
Another risk associated with long-term projects is the limitation of scientific data. Although my team is very experienced, it is still very challenging to predict the dimensions of the deposit and therefore challenging to predict future cash flows. Estimates are heavily used and a reason for the inherently risky nature of the industry.
Great, so now we've heard from the accounting team, we've discussed a bit of the risks associated with it. However, taking all this into consideration, I think we're in a good place to make a decision. Cynthia, did you have anything else to add?
Actually, I would like to add something. So every year, our finance team will be reevaluating the forecasted projected cash flows to reassess the project feasibility. We need to account for changes that may occur due to advances in technology, which would be a good thing because it will improve our efficiency and in turn lower costs. Likewise, there could be opportunities for expansion where our trusted geologists would come in and elaborate.
I think this is a very feasible project. From a geological perspective, this is a gold mine, pun intended. However, I do see the value in continuing to expand the deposit and explore other minerals.
From a legal perspective, it looks like we're on track to move forward. However, we do need to continue to work closely with the communities around us to ensure our environmental obligations are met.
And based on our capital budgeting analysis of this project, we're confident that we should move forward into developing the La Pointe deposit into a production mine.
I second that.
And from us over at the bank, we're definitely interested in sitting down with your team to restructure your debt.
Great, so I think that settles it. It looks like our project is a go, and Gold Diggers Inc. Could not be more thrilled to develop the La Pointe deposit into the operating mine. Congratulations, team.